The Federal Reserve is still predicting a recession will be averted, but the newly released economic data have darkened the forecast. In an ominous sign a recession may be ahead in the next couple of months, the U.S. index of leading economic indicators ticked down in May by 0.4%. The LEI had declined by 0.4% in April as well, and its drop fits the pattern of down cycles in the past that preceded recessions. A composite of 10 component indexes, the LEI is a reliable forward-looking indicator of economic activity in the foreseeable future. The LEI has a history of dropping definitively several months before every recession since 1950, except for the COVID-19 recession. The LEI was doing just fine until April. May's decline was one of several influential indicators that turned negative last week. The Standard & Poor's 500 Index, one of the 10 sub-indexes in the LEI and an indicator of recession, sank into bear market territory on Monday, June 13, 2022, when it closed 21.3% lower than its all-time high close on January 3rd. The plunge in stock prices in anticipation of a slowdown was a key factor accounting for the slump of the LEI for the past 2 months. In an ominous sign of what lies ahead for July, the 6% plunge in stocks for the week ended on June 17th will not be reflected until mid-July, when the LEI for June will be released. The 30-year mortgage rate in the first 5 months of the year nearly doubled, so it's not surprising that housing starts declined in May by 15%. Home construction affects many segments of the economy. It's a factor in growth of retail sales, wages, and manufacturing. In July, when June's housing start figures are released, we'll know if a plunge in housing starts is underway right now. Retail sales, another key driver of economic growth, weakened in May by 0.3% from April, and that's without adjusting for inflation. Retail sales slumped in May and in real after-inflation terms, compared to a year ago, declined over the past 12 months by about 6%. That's not good. Americans are dipping into savings to keep spending and maintain their lifestyle. We're spending more out of current income than in a long time. The savings rate at 4.4% is below where it was in the last expansion, and that's also not a good sign. Bear markets and recessions have come and gone in American financial history. The Great Recession and loss of 50% in stock prices was a deep and long recession by modern historical standards. This downturn is different from the last one. Unlike 2008, there is no global financial crisis or mortgage debt bubble. Even if the economy slips into a recession, the U.S. has always reverted to a growth cycle, and now is the time to make a financial plan for the next recovery.